Good. Can you hear me okay? I actually think I have two instances of the Essentials Room opening, and I'm trying to find the other one on my just on my internet and having a tough time finding it. So if there's an echo and you can kick it off from one of them, let me know. So let me try to find it. But if you can, that would be great. So just to let you know, this is all about just economic reports. So that's all this is right now. Good, good. Thanks, Soren Eagle. Um, the snakes are back in their normal room. I'm thrilled about that. I miss them already. So no, all kidding aside. But this is just about economic reports. Now, let me just let you know there's all shapes and sizes of what I use for economic reports. So one of them that I think is important is rebalancing. So when you get a big divergence between bonds and stocks, a lot of times you see the stock sell off at the end of the month. So just keep that in the back of your mind. That's all of a 2-minute thing to talk about. I'll show you this chart because I think it's a big deal. Number two, me and David Starr, usually when we put our heads together, we both get headaches. But no, all kidding aside, we've been harping on this with the XBI. We came in long XBI. Unfortunately, I got out too early. But this is number one. I want to show you why it matters now, because you might say, oh, why are you showing economic reports and showing the divergence between the bonds and the stocks? And I want to show you why. Because when you see this and you see this kind of rally in the S&P since the beginning of the month, so that's right here, right there. Right there. And you see what the bond market's done since the beginning of the month. A lot of times 50-50 funds have to sell stocks and buy bonds by the end of the month. Now, keep in mind, though, the bond market's gigantic. In my experience, the bonds haven't moved as much as the stocks have in that rebalance. But that's not the point. The point is that's something we're doing in the chart patterns mastery, and that's why we're leaning short today, the QQQ, and leaning long the XBI. But that's not the point of what we're talking about here. What we're talking about here is when there's this big divergence and you have a big government report coming out like the CPI means more when there's already a divergence. So just keep that in mind. The CPI means more when there's already a divergence. Now, that doesn't mean you have to go down, but if the CPI is down and the bonds have another leg down, yeah, that usually really negatively influences this. But there are a couple of other ways to show you. So, first things first, wanted to show you on how I look at the list of economic reports. There's a number of ways to do it. This is what I post on our site the beginning of the week. Just to let you know, let me get it up here. So the beginning of the week, I've been showing those daily returns, the earnings, but we've been showing that the most important. Now, this from last week. I didn't do one Sunday. I was traveling, just got back from the money show. But this is what I wanted to show you. Is you go into here, the economic calendar. This is all we're doing is economic calendar. And like I said, there are times and a place where it matters more. So when you get this divergence between bonds and stocks, I don't think like the durable goods order matters. I think it's the CPI because I think that's what the Fed's watching, that kind of stuff. So let me just say, and there's a couple of other things that have become very important. So first things first, I go to investing.com and I go to economic calendar. So I'm dual broadcasting with the YouTube room, and the copy and paste is a pain. I hope it works. So this is the first thing I do. I go into this week. And then what I do is I'm very US centric, but we're caring about US markets. I go into filters and I clear. And all I do is I make it the US. The second See the 2 and the 3, those are the most important. 3 is hard to fit all on one screen, and a lot of times it has things that aren't that important, like distillate stuff. You can add both, but number 1, I want to show you with it. And I'll show you there's going to be a ton. So there's building permits, new home sales, durable goods, S&P, HPI. That's what I'm telling you. It just gets too many. On the other hand, then you got to look between the lines and see Fed Vice Chair Supervision Barr speaks. And that's only 2. So you sort of have to have that in there. But so I've had 2 and 3. And the reason I've had 2 and 3 is because of these 2. The 2-year auction, the 5-year auction, the 7-year auction. You know, they have a 10-year and a 30-year. They don't have the 10-year and 30-year this week. So look at all these Fed speakers on Friday. You got Fats Waller talking. You got Bostic. So you got Daly. Yeah, I thought, I wonder if he's related to the Dalys in Chicago. If so, I already know what he's going to say. But the key in here is certain things matter more when the bond market is diverging. So just to let you know, just when the bond markets are diverging. So right now, when the bond markets are diverging, it doesn't matter what the results are. It's the reaction to the bonds. So if the bond market sells off on that 7-year auction, well, number 1, it's already come out. And it's a non-event. Comes out at 1 o'clock Eastern. It's already come out, non-event. So it's all on how the bonds react to the auction. Usually 7 years, not that big a deal. To me, it's usually the 10. And it's usually the 20 and the 30. But as you see, the bond market's done nothing. On the other hand, it didn't go up on it. So in a way, that's bearish. So just keep in mind when there's this divergence between the bonds and the stocks, it's not going to take much in the auctions to knock down the overall equity markets. That's the way I look at it. Now, if the bonds are up a point and they've been up, and so there was a positive divergence for a long time, then if they have a little torque down, I don't think it matters. I think it matters now, but it's probably going to matter more next week. So number 1, you still have this divergence of bonds and stocks, and there's an end of the month rebalancing. So 50-50 funds that are long up their neck in stocks and long bonds now have less weight of bonds. So they're going to have to buy bonds and sell stock. Now, the first mistake I've seen a lot of traders is they go and they buy TLT or they buy the bonds. The bond market's gigantic. It can absorb a lot of buying. Just keep that in mind. It's the stock market. Then the other thing is, what are the fund managers loaded up to the gills with? They're loaded up with about 7 stocks. So, and what stocks are acting the worst today? The big ones. Yeah, the NVIDIAs, the SMCIs. So that can go on till the end of the month. No doubt about it. Number 2, though, is getting back to it with these reports. Which ones can really move the needle? Like I said, 7-year note auction, I don't think is a big deal. So I just don't think that's a big deal. But tomorrow, yeah, Bostic and Williams speaking, that can move things. It could. It could. Crude oil inventories. And this is the thing, when certain charts get out of whack or have certain patterns, then those reports start mattering more than they did. So let me show you what I'm talking about. So here's your bond market going down. Now, we in the Chart Patterns Mastery, we look a lot at commodity indexes. And when you go to DBA, you're going to see DBA straight up. Yeah, see how it went down the end of last year? And the bond market went up. The long bond hates inflation. As you see, the DBA is up here, and the bond market sold off. So in fact, if you put a monthly chart, the commodity index that includes just commodities is where it was in 2016. So now the next thing everybody is watching is the DBC. That's the ETF that includes oil. Oh, this hasn't done much. I mean, bonds have gone down, this has gone up, but it's that structure. It's this structure right here. And that's where government reports matter. Because if you have a bullish structure and the government report comes out that the inventories are low, that might be enough to get this to break up. Now, let me just tell you, I wish I was doing this for 2.5 hours. You could do an entire class on this. But the key is the probability. And the probability is if that is tighter than expected, that could help crude oil break up. There, look at that bull flag. That's not going to take a lot of a report to get this to go up. In fact, it might go up even if the inventories are higher, and then the pundits on CNBC will say it's because of the inventories. But it's really, as you see, technical. But if this breaks up, then probably the DBC breaks up, which makes the bonds less likely to have a good rally. And the Fed is watching that. The Fed's watching the inflation gauges. They got to watch the inflation gauges. So that's why I think, well, number one, we're in a mania. I mean, don't forget that. We're in a mania in the NASDAQ. This is like 1999, 2000, where the bond market interest rates are going up, but the AI fever is just taking everything up. Eventually I'm not going to say eventually it ends because that's a real cop-out. But usually you see a turn and then a consolidation. I'll show you that in a minute if I have time. Usually you get a break and then a consolidation. See this trend line? A lot of people are trying to draw this trend line. That's awfully steep. You'd rather see one that's a little more like a 45-degree angle. So tops can take a while. Tops can take a while. But I think that the Fed saying that they might postpone any rate cuts till June is attributable to the DBA, that a lot of inflation is not going away like they said it was. And you know it when you go to the grocery store. So just keep that in mind. I'm watching that carefully. I'm watching crude oil carefully. And because of that, I have to focus on this report that I usually don't focus on. And I'm focusing, I know it says 3 stars, but usually I blow it off. But if that goes up, then bond market's going to go back down. GDP, I'm not sure that matters. It's more inflation that matters right now. That's the other thing. Here is all the economic calendar for this week. Here's the economic calendar. Now, you could use this by that. You could use it by Market Watch. There's a number of different economic calendars, but this one has worked for me. The other thing you can do is go to the schedule of releases of the CPI and see what it's done other times. And I'll show you a way that we can use that. And then you have the Fed meeting calendars. And like I said, the more divergence between the bonds and the stock market, the more that these things, if they affect the bond market, can really nail the overall market, when the overall market is like Teflon. Just might take some time. So that's one thing. The other thing to show you is this, and I think this is a big deal. I go to Google Alerts. I mean, it's free. I go to my account. I create alerts like end of month rebalancing, S&P rebalance, JP Morgan collar, David Starr. I had to add voodoo lines. Just had to do that for you. And thanks for the shout out about XPI that you put all over Twitter. Thank you so much. It was really nice of you. But you go into all these voodoo lines, S&P rebalance. I do not have Taylor Swift in here. Don't worry about it. I don't have that in here. I have all stock stuff except for my name. Triple witching, end of month, quarterly rebalance. Well, guess what? Look what I added today. Most important economic reports. I just created an alert and then I edit it. That I only want once a day. and only the best results. And look down here. That pops out. Now, keep in mind, this is Business Insider India. Doesn't matter. Futures whipsaws, Wall Street waits for key economic data. I think this is pretty cool. And you get that delivered right to your inbox. Now, if you want, you can have this all day. It just, most important economic reports is pretty general. You might get like 8 million of them. So just keep that in mind. But those, I think, are a big deal. So you have these economic reports. Like I said, certain divergences or chart patterns mean these become more important. So just keep that in mind. Now, there's a couple of other things I think are interesting that I think you'll think are interesting. When you have a divergence, a lot of times I talk about the CPI, and I talk about that stocks are going to revert to unchanged if they're way up on the day before the CPI. Well, that's not necessarily true. They're going to revert, at least they have in my experience, when the stock market and the bond market are diverged this much. People get real nervous. So if the stock market is up, let's say at 2 in the afternoon, and the bonds are refusing to rally for days and days, it's more likely this is going to go to unchanged, which I think is a pretty cool thing, because all we're trying to do is increase our odds of success. So let me show you, let's just say, we're going to go into the last CPI. Last CPI was right here. February 13th, right here, 2024. Remember, we still had the divergence. So we want to go to February 12th. We want to see if there is some kind of reversion. So let's go to February 12th. And what we're going to do is we're going to go backwards on demand. So all we're doing, this is a really handy thing as long as they have it, of rewinding. All we're doing is rewinding. So you go back if you need to double check. And I've had a problem with having too many instances of things up. So I'm going to take that one off. There, I have up a lot of charts. So I figure if I have enough charts, I'll be right on one of them. So, but all kidding aside, so economic report, February 13th. So what we're doing is we're going to February 12th of this year, and we want to see if the market's reverted at the end of the day because of the divergence already between bonds and stocks. So let's see. Now, if it's up 42, I guess I'm wrong. But let's just see. It's pre-buffering. Just keep that in mind. And there. Now, what do you notice about this? This was a beautiful thing, and we made some good money on this. What's the high? 50.48. Where'd it close? Near its low, almost unchanged. That's a surprise. Go and look at the S&P in here on a 1-minute chart. There you go. Is that a beautiful thing or what? I'm not talking about the opening. I'm talking about into the end of the day because everybody's nervous because of the bond stock divergence. Just keep that in mind. Bond stock divergence. And the bond market hadn't rallied that day if you look on the upper left. Now, if you're like, well, I can't just blindly short into that because you might short here. Well, there are a couple of ways to do it. One of them is you look for that. But that's tough. As you see what happened, like I said, this is usually the last 2 hours. Well, this is a bear flag. That's all you need to make your week. You break 50.35, it goes down by that amount. That's 10 points. So that gets you to 50.25. That's a huge percentage gain if you buy out of the money puts in the last hour and a half. Look at that. What happened? Yep, it reverted to unchanged. So that's when the CPI becomes important. It becomes important when there's already a divergence and people like me get nervous. There is no way I want to come in long when there's that divergence. It doesn't mean you can't go up. Don't get me wrong on a CPI, but it does mean I better be careful. So you might say, well, how about January? Well, January, look where we started. So the S&P was right here, right there. So when the report came out, it hadn't moved. Look at that. Hadn't moved. Bond market sold off, but this hadn't really gone nutso. So just keep in mind, February 1st, look what this did in 2 weeks. Look what this did in 2 weeks. That's why it was so important. Now, if you go into here, into the end of November, you see that both of them went up. There was no divergence. It's very rare to see that much of a divergence. And keep in mind, it's the CPI is in the middle of the month. So if you see a big old rally in the equity markets and a big old sell-off in the bond markets, then it's more likely to revert. Just keep that in mind. It's all about percentages. Let's go to right here. So here's May 15th. See right here? So stock market went, survey says, from here to here. That's pretty good. The bond market went from here. Look at that. Non-event. It's very rare when it matters that much. So here's a big rally, and here's a big sell-off. So let's look at this one. So we're going to go to this one. And darn it, I wish I had more time. So this is July of 2023. So, and does this make sense of what I'm talking about? It doesn't work every time. But when you see a divergence, a lot of times you get you get a reversion at the end of the day. And as you know, with end of day options, that can be worth a lot of money. So let's go back to this. I almost forgot where I was. Right here. So we're going to July, the CPI for July. Now, I don't remember if that one works. I could look like an idiot with this, but we're going to go back here. If I can find it. Let me see if they go back. Nah, they don't go back that far. Oh, wait. Survey says, let's see. Yes. There's a lot of them, a lot of different data. Now we're going to July. So just keep that in mind. We're going into July. So we're going into the July CPI, July 12th. So we're going to July 11th. So all I'm doing is I'm trying to take one time when there was a divergence between stocks and bonds. So we're going to July 11th. It's not as good as now or in the middle of February, but let's just go anyway. So I went to the government reports. I'm going to July 11th, and we're going to use that on demand again. And like I said, this wasn't as dramatic. Well, what do you notice? There was never a bear flag. So I can have all the theories I want, but guess what? It never had that bear flag. And like I said, the divergence with bonds and stocks, it just wasn't as extreme as the one in February. So there are times it matters. I think the crude oil one's going to matter tomorrow. So definitely, if the crude oil, and this is at least my theory, when I see crude oil look like this, and it's already up. But when I see the crude oil act like this, and I think you see what I see, it's not going to take a lot from that crude oil inventory report to get this to break out to the upside. Now, it doesn't mean it's going to, but a report is going to act a lot more positive if the chart is already backing it up. So just keep that in mind. In fact, I wouldn't even go in CVX. I'd go for OIH. Look at that. That's trying to form a bull flag. So if I'm going to play something, number one, I don't usually like playing in government reports. Like you saw with the CPI, I was betting the night before for a reversion. Just keep that in mind, a night before for the reversion. But if I was going to play it, I'd be playing the OIH over the market. Unfortunately, it doesn't trade a lot of options. So that's the problem in here. But the key is we're looking at the economic reports and we're looking on what the underline, how it would act on the report. So because the crude oil already looks good, if crude oil breaks this, then OIH is probably going to break that. So I'm not saying I'm buying a darn thing overnight, but I'm just saying that that kind of construction, that oil thing right here can make a difference. So now you might say, how about new home sales, all that stuff? Sure, that can matter. But I've just found lately, it always changes, but lately it's all about interest rates and the divergence. So that's one thing. Now, I promised I'll try to show you this. So here's the bond market. I'm just going to take TNX. We're going to take the bond market on a monthly chart. This is the 10-year, but I can't go back enough on ZB. So here's the 10-year note rate. Seeing how it went straight up? On the other hand, you had the QQQ going straight up. There's a moment of where it's a huge divergence, but right here, there were so many trying to short it. You can't short a mania. I just can't stress that enough. You got to wait for the cross. So now if I go into 1999, where was the cross? The cross is when you finally got that kind of trend line. Now that's a weekly. It showed up on a daily also. Now I'll show you. There. So you got that. Yeah, it never broke a trend line till here. And that was no bargain. That was a better short right in there. That was a year later. But you see it right there. But the point is that bond stock relationship in a mania can go on longer than you ever imagined. So I'm just showing you on how I'm going to try to play the CPI. Now, the next thing is the PCE coming out. Does the PCE matter as much as the CPI? Well, here we go again. It might. It might because there's such a divergence. So the night before, I'm probably going to play the markets to the downside the last 2 hours, the S&P. So plus, you still could have some rebalancing. So I hope you've enjoyed that. Like I said, there's a time and a place to make your own decision of what is going to be really important. Like I said, right now, what's really important is a divergence between bonds and stocks and looking for reversions to the mean in the stock market if it opens up and there's still that divergence before a big economic report. So I hope you enjoyed that. Thanks for listening, and I will talk to you later.